Hi everyone. After a long time, the markets are finally selling off in a meaningful way. And the question all of you are probably asking right now is, how bad will it get? And that's exactly what I will try to answer today. Before I move on, I have to remind you that this video is not investment advice, and if I'm gonna speak about specific financial instruments like futures, spreads, ETFs and others. It is always just for educational purposes. 2 weeks ago, on Friday at the end of March, my Bayesian model for the stock market issued a full-strength sell signal, and it was spot on because it nailed the top with a daily precision. So I hope this notification on our Twitter helped you to avoid unnecessary losses. When I open up the chart of S&P 500 futures, here is exactly the day when my model issued the sell signal, and as I said, it was exactly the top, which is a lucky coincidence because it's not a short-term model, it's rather a medium-term model. So it's very rare to nail the top with a daily precision, especially the top rather than the bottom, because it's much harder to time the tops in the stock market compared to bottoms, because tops are a process while the bottoms are most often an event. But let's focus on the situation right now. You are probably curious, what's the current model's reading? Well, I can reveal that the output from my Bayesian model right now is weak buy. So it is giving a weak buy signal. What does that mean? Well, first of all, the weak signals, either buy or sell signals, are not important that much because the market can stay in the weak signal for a long period, and it is actually the strong signal, either sell or buy signal, that is actionable. So from the trading perspective, it is not really meaningful. However, when I put it into context with the current situation, it is surprising to see a weak buy signal so soon after the start of the correction. You can see that the market has been going down for just 2 weeks, which is a small period of time after such a long multi-month uptrend. And the magnitude of the sell-off is also not severe. So even when I look into the data that go as an input into the model, most of it is already looking slightly bullish. So what all of this tells me is that the current correction will be probably much more shallow compared to the market expectations. I would say, based on the posts on Twitter, that the current consensus is that this will be a major correction, 10+% correction, and the consensus is that the market will drop to somewhere around 4,800. This is just a rough area, it is not a precise level, and keep in mind the level is different when you look at the S&P 500 futures or the S&P 500 index. But roughly speaking, this is where the consensus points to right now. And based on the output from my model, this seems very unlikely. I don't know how low the price will get, but I think it will not drop below 5,000, or maybe just dip below. But you know, this is just me, and this is not based on any data. I'm just speculating. Maybe it will turn around at 5,100, or maybe drop below 5,100 and then turn around. Who knows? My point is, it seems unlikely that it will move much below 5,000. So the consensus target around 4,800 is unlikely, at least for now. And speaking about my model, maybe there won't be any strong buy signal this time, because there is no guarantee for such a signal. It is not a requirement for the market to turn around. I mean, each signal has to be evaluated on its own without regard to the previous signals. So if there is a signal, well, that's an opportunity, and I can, you know, work with that. If there is no signal, it just means that there is no opportunity from the model's perspective, and that does not mean the market cannot go up or down. I hope you understand me. The model has difficulties, especially with sharp turnarounds, the V-shaped turnarounds, which is maybe something we will get this time. So that's the reason why I will probably not wait for a strong buy signal this time. So under this scenario, we may get the bottom maybe as soon as in the upcoming week. Actually, that's my base case. But once again, that is true unless the data changes in a somewhat unexpected and significant way. Always keep in mind that I use the current market data to adjust my outlook. But as I said, that's my base case. My base case is some kind of a bottom in the upcoming week. And yes, the market is overbought in the medium term. So the resumption of the uptrend is something that concerns me in the short term. I think that after we get another up leg in the market, we will finally get the market top, at least in the intermediate term, and finally the 10% correction will follow. But given the current market situation and the data, it seems unlikely we will get such a correction right now. And now let's take a look at a few other charts I have prepared for you today. So let's open them up. And I will start with the term structure on VIX futures, which is an important piece of information for me. And if you follow our research, you understand why. I used this indicator many times before. Here is the contango on the near end of the curve, while here is the contango on the more distant part of the curve. And by the way, usually I use the combination of the 7th and the 4th contract, but this time I picked the 6th and the 4th combination. And the reason is simple. When you visualize the term structure on VIX futures, you can see that the 7th contract, which is currently October, is elevated. There is some kind of surprising bump on the term structure. And we have received a few questions, few emails about this. And some people ask whether this is due to the unfavorable seasonality, as most sell-offs, major sell-offs happen in autumn. But this is too significant in my opinion, and I personally think this is the effect of the US presidential elections that will come early in November. But I won't delve into this right now, because I think, or I'm sure, we will make a dedicated video to the US elections later this year. So I will leave this phenomenon for that video analysis. So now let's get back to the VIX curve, the contango, and you can notice two things. First of all, the turn structure on the near end of the curve is roughly at 0, and that's actually in line with my model, because as I told you, during a major, or at least any kind of sell-off in the stock market, we want to see the VIX to flip into backwardation on the front end of the curve, at least for a brief period of time, something like the situation in October last year, and we are very close for this flippening, and that would be bullish in the short term. Of course, at the same time, we do not want to see the back end to flip into backwardation, so we want to see a brief backwardation on the near end of the curve, while the back end stays in strong or stronger contango. And so far it looks like that, because the back end is in a comfortable contango. We can also take a closer look at the front end, which is this chart. Here we have the S&P 500, and below it is the inverted front futures contract, the April contract. And once again, we do not see any major panic in the market, which of course is not encouraging in the intermediate term, but it's in line with our short-term bullish outlook, at least from the current perspective, because we consider a major panic when the VIX goes above 20. And right now the front contract is just a few days or has a few days till expiration, so it is roughly in line with the VIX index. And as you can see, we're still quite far from 20. Maybe that will change on Monday or Tuesday or basically early next week, who knows. But once again, there is no major panic. But the spread between the April and May is close to backwardation. So we have yet to see how the situation develops next week. But once again, my base case continues to be a shallow correction with a follow-up higher. And finally, I must not forget about the dollar, which contributed to the sell-off in equities, especially the latest acceleration in the uptrend. When you take a look at the positioning at the net positions, it is actually quite bullish, because the large speculators are net short. However, that's in some kind of disagreement with the net traders indicator. And when I analyze the rest of the commitments of traders data on individual currencies, these currencies are rather oversold compared to the dollar. So I think the net positions right now are somewhat weird, and I would probably follow the net traders indicator more closely, or give it more weight compared to the net positions. Keep in mind, we are looking at commitments of traders data on financials, and it is much less reliable in financial derivatives compared to physical commodities. Keep that in mind. So I can easily close this middle sub chart and compare the price just with the net traders indicator, and we are no longer oversold like we were near the end of last year. We are in a neutral territory, maybe even slightly overbought. And keep in mind, this is the data from Tuesday, before the 2-point rally in Wednesday and Friday. So currently this indicator is probably much higher than right now, and it is without any doubt at least slightly overbought. And I have a strong suspicion that the turnaround in the stock market and the short-term rally will correspond to a local top in the dollar index. And if you follow us, you know that we've been incredibly bullish about dollar for months. And I have to admit that the dollar will make some kind of a local top in the coming weeks, maybe days, who knows. And I will act accordingly because I have a huge long position on the dollar, so I look forward to reducing this position maybe in a major way and closing the majority of it. Who knows? It will depend on the data. Of course, we can go even higher. If you remember my interview with Dale Pinkert, I told him that my target in the short term is at 106, and here we are. So maybe we can go even higher. There is one major resistance somewhere between, I will make this chart larger, somewhere between, I don't know, 109 and 1010, who knows, somewhere around here. And maybe the price may get close to that resistance, but it is too high in my opinion to get there in the short term, especially if there will be a turnaround in the stock market next week or in the upcoming 2 weeks, who knows. So I think it is unlikely that we will get as high, but you know, the markets can be surprising. You can notice the rally over the past 3 days, so if that continues we can easily get there next week, but I consider it unlikely given the positioning and the rally so far. But don't get me wrong, I still consider the dollar to be the safest bet in the medium term. I think it will eventually move much higher. So this is just about a short-term speculation. So if someone is risk averse, it's perfectly sensible to just stay in the dollar or just slightly reduce the long position. I'm just talking about what I am personally going to do. I'm not recommending anything to anybody, and I'm a European. Having an exposure to the dollar is a speculative position for me, and given the huge size of that position in my case, I will be reducing that position. That's all I wanted to say. Before I conclude this video, I have to mention one wildcard that can turn the current situation upside down and make this analysis totally irrelevant. And that's the Iranian attack against Israel, which will be a retribution for Israeli attack on Iranian embassy, or actually a building adjacent to Iranian embassy in Syria. I am doing this video on Saturday, and the attack is expected to happen during the night between Saturday and Sunday, maybe early Sunday morning. So if you watch this video on Sunday, you probably already know the conclusion. But my point is that I consider it very unlikely there will be an outright war between Israel and Iran, simply because it is not in Iran's interest to initiate a full-scale conflict with Israel. The status quo is playing into Iran's hand because the US is withdrawing from Middle East, and that's the #1 Iranian objective. And the recent Israeli offensive in Gaza has turned the international public, or the majority of international public and media, against Israel. So all of this would be probably, or would go in vain if Iran goes, into full-scale war. Yes, of course, there has to be some kind of retribution for the Israeli attack, but making wide or full-scale strikes against strategic targets in Israel just because of one-time strike against some building in Syria, that would be improportionate, and the world would consider that to be an escalation from the Iranian side, and the public opinion would probably turn against Iran, and it would risk pulling the United States into the conflict, which is something that Iran does not want. So yes, there will be a salvo of cruise missiles and ballistic missiles from Iran and for sure Iranian proxies. But I expect that majority of it will be taken care of by Israeli air defense, and the overall damage will probably not be significant. There will be probably no strikes against strategic objects like the Dimona nuclear facility or IDF headquarters or these kind of things, because that would mean an outright war. And I'm also quite confident in this expectation because of the time that it has taken Iran to respond so far. So they are probably carefully considering the potential outcomes. And that's finally all for today. Thank you for watching us, and see you next time.